Right. Good afternoon. I'm Rajesh Vijayaraghavan from UBC Sauder School of Business in Vancouver in Canada. This work is co-authored with Sandra Chamberlain, who is amongst us, and Yu Shong, who is a PhD student at our university. Just in a way of background, before I started my job in academia, I used to work in a large bank in New York for 5 years doing risk management. And Sandra Chamberlain, my co-author, her dad had a community bank in San Diego County. That's just to say that banks have been part of us even before we started on this paper. So what's the motivation in our paper? This is a well-known argument that has been in the news recently on the connection between pro-cyclical lending and financial system stability, where during downturns there is a lot of bad loans, which means that banks have to increase their loan loss provisions, which hits both their balance sheet as well as their income statement, and then that triggers that change in regulatory capital, which directly affects banks' willingness to lend, and that in turn affects the crisis directly. So this has been in the news recently, and what regulators, and you might know better than me, argue is for banks to have more timely loan loss provisions, which means when the economy is doing well, you have higher provisions, which also means it's also easy to raise capital. Now, when we started this paper, as I said, the starting point was loans going bad and what that does to eventual lending and what that does to financial system stability. We read much of these news of when banks have natural disasters. Here are some headlines that has been over the last 10-15 years. We had Katrina, and then we had Hurricane Sandy. And this effect is, as you know, is not just in the US. We had Fukushima disaster in Japan. So this is a worldwide phenomena as to what banks do in responding to natural disasters, which takes us to the research question specifically we have in mind, building on the motivation that I told you, is first, how do banks, natural disasters affect banks' loan loss estimates, and specifically we are looking to see how do banks adjust their loan loss provision estimates as in following these natural disasters. The second question, which ties to the lending angle that I mentioned, is how do banks with more timely or more conservative loan loss estimates before the disaster demonstrate their ability to lend after the disaster. Okay, the first question discusses about their reaction after when the disaster happens, and the second question is, depending on how well prepared they are before the disaster, how is that going to affect the way they are going to lend. So what are we doing in this paper to answer a research question? We, as I mentioned to you, we exploit natural disasters as a local exogenous shock that eventually stimulates credit demand, because once you have a disaster for a bank gets hit by a disaster, as Tom mentioned to you before, that there is going to be this fact that the county or the businesses have to rebuild, so there is a sudden shock to demand for loans. And in our case, we are going to use a novel data set identifying banks that are affected by natural disaster and the damage that they result in. What we are going to do is a difference in difference model, where we are going to compare banks that got hit by a disaster and banks with similar characteristics but that did not get hit by any of these disasters. And then finally we measure how banks adjust to loan loss provision estimates depending on the weights that they give to specifically non-performing loans. And what we have in mind is, after this disaster, banks have to forecast what their losses are going to be, and that is going to be a function of the non-performing loans that they have. It could be based on historic non-performing loans or based on future changes in non-performing loans. Then what we do to answer our second research question, we follow prior research and measure provision practices that are conservative. That is, what if banks have consistently larger provisions when you factor in their non-performing loans, and then we consider banks that are more timely in their loan loss provision, and finally see how that affects their lending. So here is why our paper is relevant. One, we are going to talk about much of the accounting and finance literature that has looked into financial crisis, loan loss provision, and the lending that follow. In our case, what is novel is we are going to just identify how banks are actually adjusting to these shocks. So that's one I'm going to skip the academic contribution that we do. And the second contribution, since we are from Canada, we worry about the climate, is the fact that climate change in banks is a big risk that has been debated much in the news, but I haven't seen much was what banks are doing. But here is some empirical evidence, especially what we see is increasingly banks and counties have been affected in the US based on these shocks. So we are trying to place a paper in this setting as well. So let me talk to you about like how we are collecting the data. For disaster data, we use a database called Shelters, which is part of Arizona State University. It was previously at the University of South Carolina, I think. And what we use that is just a subset of what we have from the FEMA database. The only advantage we have in Shelters is that tells you property damages from specific disasters. Then, and on top of that, it tells you which are the counties affected by these disasters. We have bank branch information from the FDIC's summary of deposits. Then we have bank level information from call reports. So what we do is once we go to Shelters, identify the disasters that Shelters reports, we look into the counties that are affected by these disasters. We then go to the FDIC summary of deposits to identify which banks are operating in these counties, and that's the starting point of our analysis. And then finally for sum of for macro data, we use housing prices from FHFA, Bureau of Labor Statistics and BEA. Our sample period is from 1994 to 2017. Okay, so what are the disasters that we are focusing in this paper? We are going to build on a finance paper, and we are going to use these disasters. We have 7 of them: hurricanes, earthquakes, severe storms, tornado, wildfire, coastal and flooding, and these are the exact names that are from what FEMA classifies disaster as. So we wanted some comparability with prior research. So, and we wanted to at least capture large disasters, so that's why we had to restrict to these 7. Let me talk about what we do. First, as I mentioned to you, we identify banks that are being hit by the disasters. When we combine these 2 databases, we are going to call these banks shock, but these banks are shock banks. And then these are like, if you have an experimental setting, these are what the treatment sample is going to be. We need banks that are very similar but are not affected by these disasters. So we look into characteristics of banks that are similar in terms of size, deposit, loan portfolio characteristics, and also depending on the headquarters state's GDP. So we are going to call that a control sample. Here is a quick summary of the number of banks that are in our data which we are going to classify as affected. In our paper we also show the number of counties that has been affected by these disasters. And here is a quick summary of the type of banks that are in our data. To give you some information, the total assets, the mean sample in our bank, it's about 300 million. And here is the regression result that we show is the dependent variable we have is loan loss provisions. On our right hand side we have an interaction term shock times post, which is to say how do banks that are hit by these disasters react in the 4 quarters after these disasters compared to banks that have not been hit by these disasters. And what we are going to see is how forward looking they are in their provisions. So in this model all we are going to have is a term which is shock times post, and we are going to capture the relationship that with loan loss provisions. In the next set of regression we are going to interact that shock time post with various non-performance indicators. So those are the 2 main regressions we are going to have for our first research question. So let me show you the results that we have. The first, in this table we are showing what is the average effect for a disaster in the 4 periods after the disaster on loan loss provisions. Interestingly, I am going to focus on column 3. We find that if you take all banks, the average effect is somewhat negligible, and that might look surprising, but part of what we found is it's because of offsetting effects by small and large banks, and what we are calling small banks is banks that are less than 500 million in assets, and large banks that are more than 500 in asset. And if you see, this has a negative and this is a positive, and together they offset, and so you see there is negligible effect in terms of the reaction to loan loss provision. Now let's look into what the weights on non-performing assets. You see there is an increasing trend, and this non-performing asset, this is what is future weights on non-performing assets. So that's, and then you go on to like historic periods, you see there is an increasing trend that banks have on their weights to non-performing assets. So let me move to the next regression specification, where what we are going to argue is how forward looking banks are in terms of their provision estimates in terms of their weighting on their non-performing assets. So the main difference between this specification and the one that I showed you before is we are interacting shock times post, which determines how different are our treated banks and control banks. First, we continue to see that the actual disaster itself has like as negligible effect on loan loss provisions. We are, by the way, the dependent variable is loan loss provision, which is the income statement side for ALLL. And then when you look into how forward looking their provisions are, you see there is again that result that I showed you, the main effect without having to consider the disaster continues to stay here, and banks seem to have increasing weights on their non-performing loans. And in the fact that you have a positive and a significant weight on the non-performing loan at T+1 gets to show that banks are more forward looking in their provision once they have a disaster, once they are suffered by a disaster. The second part I want to show is like this term shows you how capital constrained the bank are, how well capitalized banks are before the disaster, how do they react after the disaster. So here you see that term is negative. That's gets to show after the disaster banks that are low in capital, they add little to their loan loss provision. So this is again full sample, we haven't split it by large and small bank to go into what these effects are for small and large banks. I am showing you the same table, but I am just splitting it into two subsamples as small and large. Several interesting facts are, the one, if you look into small banks, they seem to be more forward looking in their provisions independent of if they have a disaster or not. That is, if you see the change in non-performing assets, their weights is always more forward looking, and these weights for large banks it's insignificant. But on the other hand, when there is a disaster, large banks seem to be more forward looking, and you don't see that effect for small banks. That gets to show small banks are more always forward looking, while large banks tend to be more forward looking only after they are hit by a disaster. The point I mentioned. Then we look to see if there is an effect based on when they get audited. So we take the small and large sample of banks, we split into quarter 4 and non-quarter 4. What we find is small banks weekly, they do it in only quarter 4, but large banks tend to do forward looking provisions in non-quarter 4, right. And then the other aspect is EBP is earnings before provisions. What we find that large banks tend to smooth their earnings right after the disaster, that is shown by the positive coefficient you have for this particular variable. Then finally, that like large and small banks differ in terms of how their loan portfolio type. To take a more generic view, we are going to split banks on their portfolio of homogeneous and heterogeneous loans, and what we find consistent with the hypothesis we have in mind, banks that tend to have a more heterogeneous loan composition, which is we are just calling banks that have residential and commercial loans as homogeneous and the others as being more heterogeneous. We find that banks with more heterogeneous seem to be more forward looking in their provisions. So let me quickly run through to what we find for our results for the second research question is how do banks provisions before the disaster affect their lending after the disaster. We use two measures. One is conservatism, which is to say if banks are providing higher provisions. The other is more timely, which is are banks, how timely are they providing their provisions in relation to their non-performing loans. As a first test, we are going to test our assumption that are banks actually lending once they have the disaster. So here is the base case result. What we find here is after the disaster, the treated banks, that is the banks that are hit by disaster, end up lending more. We find the same when we go into the subsample of small and large banks. Into now the question of how do provisions affect their lending, we find that banks that are more conservative in their provisions, they end up not lending, which is the negative coefficient here, and this is true for both small and large banks. However, you find that this term which interacts the disaster, post period of the disaster, and banks that are more conservative in their provision, we find that they tend to be the ones who are lending, and particularly our results seem to be driven by small banks. So in the interest of time, let me just quickly go to the conclusion that we have in mind. So we document the disaster and an increase in use of more forward looking information. This somewhat we want to try to the new CCL rule, which looks for banks to have more forward looking provisions. We find that only large banks are more timelier. Smaller banks with ample provisions with higher tier 1 capital have lending growth in the post disaster period. And finally, we find no evidence that banks with more forward looking provisions are better prepared to loan demands in the post disaster period. And I look forward to your feedback. Thank you.